One of my favorite things to do as an investor is try and find that little diamond in the rough or the best suburb. Now, I do this using a whole bunch of things that we don't normally speak about on camera. This is sort of the secret sauce that we use to pick suburbs that have the potential to not just do average performance, but using history and using timing to our advantage, and some data that we'll talk about, particularly in points 2, 3, and 4 of this video today, to get ridiculously good return on investment over the long term. I'm super excited. This is my absolute passion, and I can't wait to bring this video to you today. Sweet, bro. So let's get started. Let's talk about metro markets, which is insane.
Yeah, this data piece was fascinating to stumble across and actually blew both of our minds, because we'd seen the Homely data that indicated that Sydney, Melbourne and Brisbane over the last 40 years have actually increased on average at 9.7% per annum. But CoreLogic just put out an Instagram post about 30 years of capital growth in Australia, where they look at houses in the combined capitals and houses in the combined regional markets. Now, over the last 30 years, from 1992 to 2022, we've seen property prices in the combined capitals go up 453%, compared to the combined regional markets of about 313%. So the metro markets over the long term have consistently outperformed those regional markets. So if you want the best ROI, then buying in the big cities and holding it for the long term has worked really well in the past. You know, averaging that 453% out over the 30 years actually spits out above 15%, which is just mind-blowing. So that's a bit of a longer term approach, but what would you say is another really important data point to look at when identifying long-term capital growth?
You know, one of the things that's been happening recently is we've been spending a lot of time talking to investors that we've helped over the last 7 years. So I think we've bought about 1,000 properties now for people in Sydney and Brisbane. And what started to happen is I started to see this pattern from talking to people like that we'd bought for 7 years ago, a couple of years after they'd bought, or 5 years ago, you know, talking to these people a few years after they'd bought. And what I was noticing is that on average, our clients were making really, really significant like I would classify as short to medium term returns in that first 3 years relative to the market averages. And I was at the time kind of going, well, what is the indicator that we've been buying unconsciously and making that absolutely conscious? So about 4 years ago, I realized that I was looking at the 10-year averages of an area, and I knew that Sydney, Melbourne, Brisbane had done about that 9.5 to 9.7% over that 40-year period, according to Homely. And so I was strategically going into either Sydney, Central Coast, Wollongong, Sunny Coast, Gold Coast, Brisbane, and I was profiling suburbs based on knowing their long-term return was this, and then looking for suburbs that had done 2, 3, 4, 5% in the 10 or 12 years leading up to that point, which I'll talk about more in a moment, how I understood that data to be true later on with DSR stuff. But it was just insane. And by constantly profiling suburbs that were undervalued, it meant that there was potential for a shorter or a medium term uplift in performance. And how we did this really in Brisbane, once we got really good at it, was like we started to buy within 5Ks of the city, then went to 10Ks, then went to 15, then went to all the beaches, then went back to 20. And all it is the same thing we've heard hundreds of times as an investor, is that domino or that neighbouring suburb effect taking hold. And what I'd learned is that even though some of these suburbs in the outer ring or the beaches or the middle ring of the city, when we were buying them with a 2 to 3% or 4% increase per annum over 10 years, where at that point, there were suburbs right next to them that had done 10% per year in 10 years. And I was like, shit, we're really onto something. Now, not a single investor that I've ever talked to that doesn't do this 100% of the time for a living looks at this indicator. And I think as a suburb profiler, this is the number one thing that you can do to improve if you're adding metro and houses on good piece of land in quiet streets to the equation, to absolutely nail your medium-term performance.
What you've got to really do here is, work counterintuitively to the average. So you need to understand your longer-term averages in the capital cities, which we've already educated you on. Then you're looking at this 10-year average. Now, most people are going to want to buy in a suburb that's performed really well over the last 10 years. You want to buy in a suburb that's performed really well over the last 20, 30, 40, 50 years and underperformed over the last 10 years, to put it in simple terms. Now, talking more about the timing aspect, most investors say that you can't accurately predict timing, you can't accurately predict the bottom of the market. What would you say to that, and how do we use timing to our advantage?
From stumbling across this guy called Phil Anderson's work about 5 or 6 years ago now, I think that we cannot accurately, individual suburb or property-wise, time markets. Future. So he looked at 250 years worth of booms and busts in America, and that work was taken off the back of Fred Harrison's work that looked at 350 years worth of booms and busts in the UK market. There's books actually like 600 years old and documents where people have actually been following timing of property related markets and commodities for more than 1,000 years in France. So it's not a case of like, can we accurately time markets? It's how do you learn how to accurately time one?
It's really cool, and there's an amazing video on YouTube at the moment from the team at Property Share Market Economics, which is run by Phil Anderson and his co-director, Akil Patel, where he goes into a really detailed version of this 18.6-year real estate cycle in a 2-part series. Highly recommend it.
So to give you like the real quick notes on it, and definitely read his book, The Secret Life of Real Estate and Banking, or follow his YouTube channel if you want to know more. Effectively, money moves throughout an economy when you look at the history in a very, very consistent way. What happens is we have a GFC style event, we'll call it the GFC, and then we go through about 7 to 8 years of prosperity where stock markets and property markets around the world go well. Then we hit like a pause, which normally lasts between about a year to 2 years, and we call this the mid-cycle slowdown. The last mid-cycle was COVID. The one before that was 9/11, and there's been 13 or 14 of these mid-cycle events. And then confidence slowly comes back into the market like we've been seeing in the last year. And stock markets, it's a bumpy ride. There's not this perfect linear from bottom to top thing. It looks like this all the way through. Then we get another run, which can last somewhere between 4 and 7 or 8 or 6 or 7 years. And then we have another GFC style event. Now, what's important as an investor isn't to perfectly time the suburb you're buying, but to understand where we are at any point in time in that longer term cycle. And by doing that, you understand when to take on more debt, when to take on more risk, when to stop buying, when to consider buying. And as you said before, the best buying opportunities that you and I have seen have been at the times where, statistically speaking or sentiment-wise, the market feels the worst.
Once again, very, very counterintuitive, but you hear the biggest and best investors of all time talk about this being a really common thing. Average investors get scared and avoid or sell during bad times, and that's why it can be a really good opportunity for investors in good financial positions to pick up discounts during those times, like a lot of our clients currently are.
So what I did as someone who just can't help myself with data, this is my passion. Like, this video is what I love. As much as I like buying a bargain, like, this is equally good.
We said that this was going to be a 5-minute video before we started recording. You watch it turn to 20.
We'd be lucky to get, we're over 20 guys. Just crack a beer or do a couple of extra reps at the gym or extend that drive, because this is going to be one of them for those of you that love this stuff and really want to invest better. But as someone who loves the data, I then went, well, they've done the UK and then Phil did America, and America and the UK drive Australia. Australia for the last 13 cycles has been at 12 months behind America, which is beautiful. That's how Australia gets out of GFCs, because shit hits the fan over there sooner. And we've got like a 2-month, 3-month, 1 year lead time on that disrupting our market as well, so the government can get ahead. But in Australia, the pattern after the GFC seems to be that Sydney and Melbourne, the most diversified large economies in Australia, do better first. And then in the second half of cycles, they still have done very well, but sometimes not as well. And then your second tier cities, which don't really do as well in the first half, like your Brisbanes, your Adelaides and your Perths, seem to do better. So as an investor, when I'm looking to buy a suburb, first half of cycle, I'm looking at Sydney, Melbourne. Second half of cycle, I'm looking at Brisbane. And that is a very, very easy way to get focused on which market you're going to buy in.
And it's good to have that clarity as well as to where we should be spending our time and attention focusing, because it's quite overwhelming to try and understand or analyse the amount of suburbs that there are in all of these big cities and Australia as well. So to simplify it and go, okay, well, you know, for me, it's just Brisbane and Sydney probably, because they're the two markets that I know the best, and I know I can get above average capital returns in both of those markets, knowing that they run on two completely separate cycles as well. But if you're from Melbourne, you might want to go, well, look, I'm just going to look at Melbourne and Brisbane in each of those cycles as well to capitalise and generate better returns on our investment, because you know, based on these cycles, it's very rare for properties to double in value every 10 years these days. So you need to work smarter, not harder, to try and get those returns in your favour.
You know, it's interesting because I was just watching the Warren Buffett doco on HBO, and there's a picture that he's got somewhere in his office, which is the one that everybody's seen of the batter. And so a guy wrote a book very similar to Moneyball, but about baseball a long time ago, and he looked at thousands of different people statistically, and he found the difference between a great batter and an average batter and a poor batter, statistically speaking, wasn't who could hit, it was what they didn't swing at. And so Warren has that on his desk or on his wall or on like the wall, like the walkway to his office, which is filled with every market crash in history as well, to remind him of what can happen at any time. And he says, like, even Warren, like, he just hasn't gone big into some tech stocks because he doesn't understand it. He stays within his lane. And I like what you said, like, you're going to stay in the Brisbane and Sydney lane because we can't be everything. And we cannot get above average returns and understand timing without being obsessively focused on one market, one part of a market, one suburb, which leads me on to this. So I'd looked at the big picture. I pieced together the 10-year average thing. But then I found this piece of information from Jeremy Shepherd at DSR, where he looked at every single suburb in Sydney statistically over 25 years. There's always been this idea that closer to the city and closer to the beach is more expensive. And so people spend more money and get less property and less leverage by buying one asset, as opposed to this piece of information, which has completely changed the way I invest. And what he found over 25 years is that, statistically speaking, between the top performing suburb in Sydney and the worst, there was less than a 1% difference per annum in the capital gain. So theoretically, Bondi Beach and Penrith or Parramatta, statistically speaking, over 25 years will do the same. And you used to hear a lot of our older commentary, which was buy within 20 k's of the city, buy close to the beach. And now you're not hearing that because it is statistically irrelevant, and it is a massive blind spot when most investors are choosing suburbs. They're following what's worked, which looks like closer to the city or the beach. But when you buy $1 million property that doubles, it's worth 2. When you buy a 400k property that doubles, it's worth 800. And so statistically, they've done the same, although the risk was lower on one of them. And therefore, people overestimate these blue chip locations and underestimate all of the incredible quality, affordable stuff left over.
And it makes me feel a hell of a lot better as well, because, you know, if you feel as though you've missed the boat, or you feel as though you can no longer afford to buy into the suburb that you would ideally like to buy in, there's still opportunity. It doesn't mean that you've missed the boat. It just means that you missed that boat. There's another one coming.
Without a doubt, bro. And we've seen it in Sydney. Like, you and I have very closely watched the last 10 years around what's happened there. And we've been watching Brisbane now for the last 7 years as a business, and I've been watching it for almost 11 years as a personal investor. And it's like, there is incredible opportunity. Like in Brisbane right now, there's some suburbs within 10 k's of the city that have doubled in value in the last 8 years. There's other suburbs within that 10k ring that have done 5%.
Yeah.
Knowing Jeremy Shepherd's data, what he went on to say after looking at the 25 years in Sydney was suburbs that do better in the first 10 years of a cycle do worse in the second. Suburbs that underperform in the first 10 years do better in the second 10. So when people are giving you shit because the only suburb you can afford in Sydney right now is Liverpool, but Liverpool, I'm just making this number up, I've got no idea, let's say has done 6% a year per annum for the last 10 years versus Cronulla Beach that's done 12% a year for the last 10 years. they don't understand what you're going to begin to start seeing after watching this. And I want you, hopefully for the rest of your life, it is so easy. Cronulla Beach plus 10-year average, you've got your number. And if you know Cronulla's done 9.5% a year for the last 50 years before that, according to Homely, it's really that far. If the 10-year average is high, then maybe that's not the area to look for. If the 10-year average is sitting between 2 to 4%, there is a very strong likelihood of medium-term gains.
And what I love about...
Cycle dependent, though. If you're buying it just before a GFC, then you might not get anything for a while. Cool, bro. So we've sort of talked about this idea of metro outperforming regional markets. We've talked about the long-term timing cycle and Sydney and Melbourne versus Brisbane at different stages. We've also talked about Jeremy Shepherd's idea after looking at Sydney for 25 years and going for suburbs, and then this concept of the 10-year average so people can buy better suburbs at better times in the cycle. But there's a whole shitload of other stuff we do. What are some of the big rocks for you?
Now, Jeremy Shepherd, who we've been talking about, actually created the demand to supply ratio, where he used a number of different metrics to figure out how hot a suburb is at any given time. And it spits out a number between 0 and 100 essentially. Now, basically, in simple terms, this DSR score indicates that the higher the DSR score is, the hotter the suburb, meaning it's more of a seller's market. And the lower the DSR score means the lower the demand in that area, and it's generally going to be more of a buyer's market. So for us, there's a sweet spot here that we've figured out over time from buying so many properties over the years, which what we're looking for at the DSR score is to purchase in suburbs that are sitting somewhere between about 55 to 60, all the way up to about 85. Now, this indicates that there is enough demand in the market that is going to, have properties consistently selling, but it's not so hot that properties are selling too expensive, too far over the asking price as well. So you really want to be sitting in a little bit of a sweet spot there, and it will help you understand where things are going to be moving. Now, to put this into context, suburbs in inner city Brisbane in November of 2021 would have had DSR scores sitting at 85, 90, maybe even 95. And that was because properties were selling in a couple of days. Properties were selling significantly above the asking price. And we heard it out there in the media. Everybody was talking about what a good seller's market it was. Now, about 9 months later, we're seeing the DSR score in those same suburbs come back down to levels between about 50 and 60 at the moment, meaning it's a much softer market at the moment. We're not seeing many short-term gains there anymore. We're not seeing as much demand there anymore. And it's much more of a buyer's market where people can come in and get a little bit more of a discount. So it just helps to understand what the demand to supply ratio is going to be looking like in any given suburb at any given time.
I really like that, man. So when the DSR score in some of those inner city suburbs that we stopped buying 5 or 6 years ago because the 10-year gain was already priced into them then, but they've gone up since then as well. Sometimes when that DSR score is sitting at 85%, I saw some of those suburbs increase in value by between 20 and 45%. Like, that's how much pressure and how much of a good indicator that is. And I've seen, suburbs around Australia sitting at 50% DSR scores, and you can almost expect a flat year, maybe a year that goes up by 5%, or maybe a year that even goes down by 5 or 10%. So it can be a really nice way to just quickly sort of pulse check where the market's at. And then we don't want you rushing into markets that are ridiculously hot. We want you to use, because last year in Brisbane, there were suburbs with an 85% DSR score. 7 Ks down the road, it was a 60% DSR score. This suburb had doubled in 10 years. This one had done 3% per year over 10 years. And we were using that to guide the investment decisions that our clients were making at the time. And it's worked beautifully.
Absolutely. That's one of the best things that you can use, the combination of the 30-year or the 40-year average, the 30-year average, the 10-year average, the 3-year average, the 12-month average, along with the DSR score, paints an amazing picture.
We do a bit, hey?
Just a little bit. And hey, fortunately, it is working. But there's some other things that we love to look at as well. Now, obviously, days on market gives you a pretty good indication as to how hot a property market is as well. Now, this is going to give you an indication of what might be happening short term. Now, the lower the days on market means property is hot and properties are selling really quickly. Great for the sellers, great for the real estate agents, very, very challenging for us buyers and investors. Now, the higher the days on market means that you've got a little bit more time and capacity to negotiate with the agents. You might be able to secure properties at or below market value if those average days on markets are starting to get a little bit longer as well. So for me as an investor, I prefer lower DSR scores. I prefer longer days on market because I have so much more power in those negotiations, which can impact the short-term capital growth that I can get as well if I'm buying those properties below market value.
You know, I love days on market because it's a really good bullshit indicator for real estate agents. I think someone must have wrote a How to Sell Real Estate 101 guide, and at some point they said, anyone that picks up, tell them that it's hot and we've got another offer on the table and you have to move quick. And it's like, nah, man, I can see that those DSR, the days on market are over 40. I know that you're talking trash to me. Or, hey, I can see the days on market are 10.
You're not lying.
Like, whether he says that or not, this is going to sell like today or tomorrow.
And you got to just, take it out. It takes that emotion away from things and just puts a bit of a process in place as well. And rather than getting played by the agent, you can sort of, have a bit more control and sanity there, because that's the emotional part of buying as well when you're actually in the negotiations with the agent. But the next thing that we like to look at is obviously the vacancy rates as well. This is really important from an investment perspective. I'll let you add on to this as well because you have some really cool theories here. But vacancy rates is looking at the available rental properties in any given suburb. Generally the lower the vacancy rate, the better. For us as a rule of thumb, we try to avoid buying in suburbs that have a vacancy rate above 2% because it might mean that there is a little bit of a few too many properties that are available for rent there. Now, if it's below 2%, it's the complete opposite. It means that rental properties are completely undersupplied at any given time, and you're going to be able to find tenants relatively quickly to reduce those days on market, to keep your cash flow looking a little bit better. What we've found from looking at the vacancy rates and capital growth is actually a decent correlation between really low vacancy rates and actual short-term capital growth as well.
Yeah, so I'm just so grateful, I suppose, is what I want to start by saying.
I might just say this, that Ben is the most intuitive person that you'll ever meet in your life as well.
Yeah, I was just going to say, I just constantly stumble over these random things that completely change everything for me. And I remember looking one day, I had one screen open, but for some reason my browser dragged a screen across. And so I had Google open and I was looking at 20 years worth of property price ups and downs in Sydney, Melbourne, Brisbane, Perth. And it was actually Perth that got me to this thought. And then at the same time, I had another email with 20 years worth of SQM vacancy rate data. And I just went, these are the same charts. And I put the screen together and I'm like, when the vacancy rate in a city holds at below 1%, which means the rental market is chronically undersupplied, chronically undersupplied, people sleeping in cars undersupplied, then people get the shits with renting and they start looking for houses to buy because they're like, I can't buy. If the cost of finance at the same time is making it about the same price to pay the mortgage as it is to rent, then we get this thing that happens, and the charts looked almost identical, whether I looked at Sydney, Melbourne, Brisbane or Perth, and I just went, shit, I found a silver bullet that nobody I've ever heard in any book, any podcast, anything. We never talk about it online because it is a silver bullet and I like to keep it for clients.
It's one of about 50 silver bullets that you need.
Yeah, I've got a Word doc that's pretty full now on lessons that matter for my kids and their futures and my grandkids. But this one is insane. And if you can just buy suburbs with a vacancy rate below 2%, one, you'll have lower periods of vacancy, you'll get higher rents, you'll get the price pushed up over time on the rents as well. But if it holds, your capital gains in the suburb you choose could be exponentially higher longer term. And then if you overlay quality of suburb, capital city, a completely landlocked suburb closer to the city or the beach, then we're talking about there's going to be supply issues for the rest of that property's life.
With experience and spending so much time analysing all of these different charts and all of this different information from all of these different partners, you really start to figure out, okay, there is a bit of a method to the madness. And, I love that you've explained that there. But some of the other things that we're looking at when it comes to potential for capital growth is the demographics within a suburb. That's certainly going to impact the quality of the people, and the amount of money that they're going to be able to spend on rentals plus buying homes. So the two things that we really love to look at a demographic level is the split between owner-occupiers versus renters, and also the average household income. Now, with the split between owner-occupiers and renters, in an ideal world, you want about 70% owner-occupiers to 30% renters, but there's no silver bullet here. There's no one size fits all. You know, if you're buying in a suburb that has, say, 35 or 40% renters, if the vacancy rate is a little bit lower, then you should be able to find some tenants there as well. But as a rule of thumb, you want more owner-occupiers, because then you know the tenants are trying and striving to become owners within that suburb. It's going to put more pressure on your neighbouring properties. And obviously we know that mums and dads that are buying homes to live in are making more emotional decisions than logical decisions like investors. So when you're competing with those emotional mums and dads, unfortunately sometimes it means you miss out on pricing because they're willing to pay a higher price than you are. But what that naturally does is drives up the median house price in the suburb as well, and you can reap the benefits of that if you also own in the area. And then looking at the average household incomes, you know, the more money that people are earning, the more disposable income that they're going to have for mortgages, for rents, for making any upgrades to any properties and things like that as well. So you'll generally see suburbs with very high average household incomes. You're going to see many more beautiful renovated homes. You're going to see much nicer gardens and things like that as well, which once again adds to the emotional feel for the suburb, attracts more owner-occupiers, drives the prices even further. So there is definitely a correlation that you can use between those two things.
You know, I love that, man. Like, it's really simple, right? Like, where would you want to live if you're earning $100,000 to $200,000 a year, and then get as close to that as you possibly can? Like, because people with money, surplus money, spend it on their own homes in Australia. That's what we do. And when that concentration of wealth ends up in an area, then more and more people do that, and it brings up the overall vibe. It's really just, you know, and I've got many suburbs that I own in where the incomes aren't anywhere near that high, but people really, really, really care about what they own. And I think longer term, I can see those areas becoming those types of places because of that care factor.
Exactly. And it's sort of, there's another one that we look at as well, which is different. You know, obviously in an ideal world, you want to buy in the blue chip, beautiful suburbs, but it doesn't always end up being the case. And what you can use there if you are stuck with a lower budget is using the idea of gentrification to your advantage as well, which is buying in a suburb that may have a little bit of a stigma about it. It might have some lower socioeconomic demographics. Maybe the percentage of renters is a little bit higher. The percentage of public housing could be a little bit higher. There might even be lower household incomes in those areas. Actually, it's very likely that the average household incomes will be a bit lower. But if you can look at some other key performance indicators or some neighbouring suburbs, and you can sometimes indicate or see a disconnect between that, where a suburb might be very affordable and the data looks like, well, this place is actually gentrifying. We can see more mums and dads moving into the area. We can see the average household incomes picking up a little bit. We can see the percentage of renters declining a little bit, which means you can get into these areas before they turn into beautiful blue chip suburbs at super, super, super affordable property prices, and then the market's going to change. Now, one area that we've seen do this very well over the last 2 years in the short term is Crestmead down in the south side of Brisbane in Logan City Council. You know, historically one of the worst suburbs in Brisbane, but as property prices have become so expensive closer to the city and in some of the neighbouring suburbs, people are looking at properties in these suburbs and going, you know, that's amazing. I can buy a beautiful 4-bedroom, 2-bathroom renovated house for less than $600,000, where a property, you know, 5 kilometres away from that is selling for over $800,000. You know, there is a huge disconnect there, and you can actually use that to your advantage to keep your debt levels a little bit lower and maybe get a bit of a higher percentage return in capital growth.
You know, one of the most incredible things that have happened for so many people is they've seen Sydney and they've seen Melbourne gentrify, and Brisbane is the next Sydney or Melbourne. The ABS says it will be 5 million people within 22 years from today. So you've seen the change. Like the suburb that we grew up in had a very high percentage of renters when we lived there. It had a pretty high percentage of housing commission too. 30 years later, it is absolutely stunning, surrounded by beautiful homes. Like, a lot of people that are earning good money live there now. The places have gone from 100K 35 years ago to well over $1 million now, $1.5 million in some instances. And that's what is special right now. I think about your Darwins, your parts of Tasmanias, your Brisbanes, your parts of the sunny coast, your parts of Perth, your parts of Adelaide. There's many people that have never seen major gentrification. And my favourite thing to hear is when someone writes off an area that is super close to the beach or super close to the city because of what it was like when they grew up or what it was like 5 years ago. I'm like, that is money. And then almost 100% of the time when they're doing that, you look at the 10-year average number, below 5% for the last 10 years. And it's like, in Tony Robbins' book, Money Master the Game, he talks about 6 biases or 7 biases that we all have as investors to be aware of. The most important one to be aware of is confirmation bias. That's a bad area. This is a good one. Or recency bias, which is, this has worked. It'll keep working. This hasn't worked. It won't work. And that's why money stays in Sydney and Melbourne for too long. And then it gets too expensive and it stops working. Where else? Brisbane. Brisbane pumps. Everyone comes in late. Brisbane's not working anymore. Sydney and Melbourne hasn't worked for ages. We'll stay away. Oh shit, it's been 10 years since it did anything. Let's go back. People just keep jumping and it's been happening for 150 years in Australia. It's crazy. I love this shit. We'll quickly touch on that last one.
Yeah, I don't know what you're talking about there.
Cool. The last one is just something that I've observed personally when I'm trying to pick a suburb with potential, because we're always looking for potential above buying and hoping that it's going to work out. When I find a suburb, and this is one of my favourite things to do for clients, that has a good variance, like let's say it's a 600K suburb like Crestmead, for example, and there's houses you can buy for 450 and houses that are selling for 700. And I'm like, I could buy that 450K home and I could turn it into a 600 grand home with a new kitchen, bathroom, some flooring, and converting the garage legally with the council into a 4th bed. And I'm like, that would only cost me 80K, but I'm going to make 150 grand from doing it. And I am always looking for that opportunity. There's beachside suburbs in Brisbane now where one street and one type of property is 600 to 700K, and houses a stone away are selling for $1 to $2 million bucks. And I'm like, that is a variance worth noting, because as Sydney and Melbourne went further through the last 10 years of the growth cycle, the variance stops. And at some points, knockdown rebuild houses are selling for the same price point as beautifully renovated 5-bedroom homes, because the market is so hot and the market has sucked up all of those gains. But in Brisbane at the moment, those gains are everywhere. And that means that, statistically speaking, whether you buy a really nice joint now with potential or you buy an absolute shitbox like both of us have and then sit on it and just wait for the finance to come in to be able to do something nicer, those variances mean that if the market's statistically going to do 5% a year for the next 15 years or 10% a year, whatever it ends up doing, and you can make another 50% through renovation work, bedrooms and bathrooms are knocking down and rebuilding, you've almost like, you've just changed your stars in a big way. And if you can do that across 2 or 3 properties, it completely changes your financial future.
Absolutely. And it just makes me so happy to know that there is a method to the madness. And when you absolutely...
It's a bit of madness too.
Absolutely obsess about this stuff for such a long period of time, you can figure it out, and we can put it together in a really bite-sized video for you in today's one, where you can look at these things moving forward and you can create a bit of a blueprint to figure out where we should be focusing, because who doesn't want capital growth? Everybody wants their property to be worth more than what they paid for it in the future. I want my property to be worth more than the average capital gain as well. And that means being an above average investor. It means working smarter not harder, and following all of these indicators and doing a lot of that research. And I know right now it could seem a little bit overwhelming and a little bit complex to figure all of this stuff out. And, we are here to support. We actually also run a buyer's agency where we help a small number of investors invest in the Brisbane property market every single month. And what we would love to offer you if you're seriously considering purchasing an investment property over the next 6 to 12 months, we'd love to offer you a free strategy session where we can talk about exactly where you're at right now, where you're looking to be in the future. We can teach you a little bit more about these key performance indicators and these data points that you can look at to identify capital growth moving forward. And you can take that information and go and smash it yourself, or you can become one of the small number of clients that we work with, and we can teach you at a much deeper level about all of these indicators. We'll actually share with you all of our intellectual property and how we've actually accumulated this knowledge and data over the years, and we'll at the end of the day be able to help you purchase an amazing investment grade property that hopefully outperforms the average over the longer term. If you want to book in one of those strategy sessions, please head over to our website www.pumpedownproperty.com and lock in one of those free strategy sessions with myself, Simon, or Benny, or our sister Crystal. But either way, thanks so much for watching today, and thanks so much for sticking through. If you've made it this far in, I would highly advise go back to the start, grab your notepad, take a couple of notes, because there was some gold in this one.
Whew,
That's a wrap.
That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
Very nice, eh?
Oh.